with Michael Feroli, chief U.S. economist at JPMorgan. Michael, I'm absolutely fascinated by the numbers that we have, how disjoint they are in our political debate. Let's start with the Atlanta GDP number, which is screaming 8%, or let's take real GDP plus inflation, which is a nominal GDP that would make China happy, or let's look at real GDP run rate of 2.2% down near the famed Feroli potential GDP. How much of this nation is flat on their back in a weak economy?
Well, not much, I don't think. The unemployment rate is, one of the statistics you didn't mention is the unemployment rate is now 4.6%. And that seems to be moving only lower. So the labor market, which is probably the most important market there is, looks pretty healthy. Inflation has been a problem the last 2 quarters, and it will continue to be a problem in the fourth quarter. I don't expect that to persist to quite the same degree next year. I don't think many people do, of course. So there are problems, but I think it would be quite extreme to say that the economy is flat on its back. I mean, real GDP is at peak levels, and we're basically back to the trend we were on before the pandemic, which was a pretty good trend.
Michael, a lot of politicians are saying it is flat on the back, and of course they're centered on inflation right now. We all understand that debate, but so much of that is the demand for wage growth and then inflation-adjusted wage growth. Can JP Morgan model that we will see an actual real wage growth somewhere in the distance?
So, yeah, I think real wages will be growing next year, in part because, again, if headline inflation comes off, we know that nominal wage growth looks like it's on a pretty good trend right now. So all you need is some moderation in things like food and energy prices, particularly energy prices, to start to see real wages pick up. And actually, one of the interesting things here that I think gets little noted is that the labor share of national income actually continues to be on an uptrend recently through the pandemic. So I do think it's a good period for workers, certainly. Vacancies are at an all-time high, and workers are getting the wage raises that you would think would occur in a labor market like this.
And this is perhaps, Michael, why we are seeing traders bring forward their expectations for the Fed to act and raise rates next year versus in 2023. You among them. Actually, you had not expected any, and last week you said you do expect a rate hike next year starting in September. What did you see that changed your view on how the Fed will respond to this?
So I think probably the most important development is over the past 4 months, the unemployment rate has come down 1.3 percentage points. Now, we know that the Fed, beginning with Chair Powell, see inflation, really persistent inflation, being driven by slack or the lack of slack, and that's moving in a direction that suggests we're getting pretty close to full employment. And that is the last remaining condition for liftoff. Having attained that condition, I think we could easily see that in the second quarter of next year. Then I think it's only a matter of time before they lift off and try and get back to something more of a normal policy setting, because the labor market and inflation are certainly looking, inflation's not looking normal, but the labor market's getting back to normal.
Michael, that's what I was going to ask. What's a normal policy rate right now?
So I think, I guess first you have to say, what is the neutral real interest rate? I would think it's somewhere between 0 and 0.5%. So that would put nominal neutral interest rates at something like 2 to 2.5%, which is about the peak we got in the last cycle. So I think until something really breaks in the economy, the Fed would seek to get back to that, in measured steps, of course, unless there's a real problem. But I think that's kind of the goal here in terms of normalization of policies, getting short-term rates back into something like that range.
When talking about the normalization of policy, you also have a number of policymakers now out saying we may need to taper more quickly than initially thought. Do you expect an accelerated taper, and does that have any real bearing on liftoff?
Certainly can't rule it out, given the pace of improvement in the labor market recently. And I do think it's kind of interesting that you had that remark from Vice Chair Clarida last week, and he knows he's out the door, so perhaps he feels like he can speak a little more freely, or perhaps even speak on behalf of the institution and the staff. So I think the fact that he was out there raising that idea suggests it's something we, again, can't rule out. I don't expect to see that in December. I do think they probably pays them to wait a little bit to see if there is a seasonality or a winter wave here before making that decision. But if it looks okay in January or March, I think that's certainly a very live possibility.
Larry Summers, the former U.S. Treasury Secretary, says get the taper over with within 3 months. Is that too quick?
I mean, right now I think it's a little too quick, but I do think there's a case to be made for that. And I guess following on your last point, or last question, really the idea here is you don't want to be hiking at the same time you're tapering, right? So you want to get the taper done. So the sooner you get the taper done, the sooner you have the optionality to hike if developments next year really turned out to be quite a bit hotter than are currently anticipated. So, right now, particularly with the risks of a winter wave, I think it might be premature, but I think as we get into early next year, that bears reconsideration.
Michael, 2% inflation is sacrosanct. I want to go to your acclaimed Booth School seminar that you hold every year, and part of that debate will be around Adam Posen Peterson Institute and the idea of a new 3% level instead of 2%. Why can't we go decimals, and are we doing that right now, and that the new 2% is, say, 2.2% or 2.3%? Are we jawboning our way to that kind of level?
So I don't think we can go to 3% for political reasons, right? So the Fed, the fact that they even interpreted price stability as 2% inflation back in the 90s was a bit of a sleight of hand on the congressional mandate. I think going to 3 would be really quite risky for the institution. Some might say that flexible average inflation targeting was sort of a backhanded way of raising the inflation target, which, I think there is something to that. On average, it should be higher realized inflation. Now, decimal points, given the imprecision of how we measure inflation, that might be a bit much. But going to 3% I don't think is in the cards anytime soon.
Michael, I want to finish up where we began the show with Tom asking a really good question. Are we just befalling hysteria with respect to inflation in these 1970s comparisons? And this issue of framing inflation in a new 2021 kind of way. What is the consequence of the inflation that we're seeing now? Is it potentially a longer lasting, higher inflationary environment that we'll have to fight? Or is it that we are going to see growth materially slow and a bigger divergence between the haves and the have-nots?
So first of all, I think 70s comparisons, I agree, are kind of hysterical. The central banks around the world have learned the lessons of that period. And that period didn't happen overnight. It didn't happen over the course of 1 year. It happened over the course of the late 60s into the 70s. I think the bigger risk here is that the Fed does, get caught with inflation that's not transitory, that is persistent. And then I do think they'll do the right thing, which is tighten policy until growth slows enough to wring out that inflationary pressure. I think the risk here is that for whatever reason, it seems like anytime you slow the economy to a certain point, or it's hard to slow the economy to, just the right level. In fact, when you slow it, it tends to tip into recession. So I think the worry more is that, not that we have a 70s inflation, but that when the Fed realizes inflation is more persistent, they have to catch up to the curve that they're arguably behind, and in doing that, they could really tip the economy back into a downturn.